All right, let's talk about the two things every investor is chasing. You've got that explosive growth, think Nvidia, and the whole AI boom. And then you've got that steady, reliable income. But what if you could smash those two together in one investment and get paid every single week? Well, there's a new ETF out there that says it can do just that. Today, we're going to see if it's for real.
And that's the million-dollar question, isn't it? Can one ETF really pull off both high growth and weekly income? I mean, it sounds a little too good to be true. You get a piece of one of the hottest stocks on the planet, and you get cash in your pocket every single week. So in this explainer, we're going to tear this thing apart, see how it's supposed to work, and maybe more importantly, what you really need to watch out for.
Okay, so the fund we're digging into is the REX NVDA Growth and Income ETF. The ticker is NVII. Our mission here is to unpack its pretty unique structure, take a look under the hood at the engine that's supposed to drive it, and then get real about the serious risks involved. By the time we're done, you'll have a way clearer picture of whether this new kind of ETF is something that could even fit in your strategy.
So you gotta ask, why this fund and why right now? Well, NVR is a direct product of this absolute frenzy around AI and semiconductors. I mean, investors were hungry for new, creative ways to play this trend. So REX Shares jumps in and launches this thing on May 28, 2025. And get this, by August, it was already spitting out those weekly distributions to investors. That created a ton of buzz, for sure.
All right, let's pop the hood and get into the mechanics. How in the world does this fund try to hit two totally different targets at the same time? It really all comes down to a pretty clever and definitely complex dual strategy.
So think of the fund strategy as being split right down the middle, 50-50. Half of the portfolio is all about generating that weekly income, and it does that using something called a covered call strategy. Then, the other half? That's just left wide open to Nvidia's price swings, aiming for that pure, uncapped growth. It's a really ambitious balancing act.
Now, for that income part, the fund uses what's known as a covered call strategy. So what does that mean in plain English? Basically, it holds an asset tied to Nvidia and then it sells call options against it. The cash it gets from selling those options, that's called the premium, is what gets passed along to you, the investor, as that weekly payout.
But wait, there's more. To really juice the growth side, NVI uses leverage. It's targeting about 1.25 times the daily exposure to Nvidia. This is where the growth part of its name really kicks in. But, and this is super important, that number isn't set in stone. The leverage can actually float anywhere between about 1.05 and 1.50 times. That adds a whole other layer of complexity and, frankly, risk. And here it is, the number that makes everyone's jaw drop, a 34.72% annualized distribution rate. Now that is a massive number, but you have to understand how they get it. It's calculated by taking the most recent weekly payout and just stretching it out over a full year. It's a snapshot in time, not a promise, and we're about to see why that distinction is so important.
Okay, so what about actual performance? How's it done so far? Well, since it launched, the fund's net asset value, or NAV, is up about 17.62% as of the end of June. This gives us our first real tangible peek at how this whole strategy has actually worked in the real world. So how does this stack up against a more, normal income ETF? It's really night and day. A standard fund might pay you monthly or quarterly, and the growth is usually capped or pretty limited. NVII is a totally different animal. You've got the weekly payouts, you keep that partial uncapped growth, but it comes with a strategy that's way more active and way more complex.
Okay, we've seen the shiny, exciting part, the potential. But you know the deal, with big potential rewards come big risks, and NVI is absolutely loaded with them. So now we have to look at what's hiding under the surface, because honestly, every single investor has to understand these risks before even dreaming about putting $1 into this. This quote right here, it gets straight to the heart of one of the single biggest risks. Remember that huge distribution rate we just saw? Yeah, it might not be what you think it is. A big chunk of it could actually be something called return of capital, which is a totally different thing from actual profit or earned income.
So what in the world is return of capital? The simplest way to think about it is this. It's the fund just handing you back a piece of your own money. It's not a profit, it's not a gain. What it does is reduce the value of your initial investment, your cost basis, and it can create this illusion of a super high yield while the fund's actual value might be getting smaller over time. So the key takeaway is that weekly payout isn't always profit.
And return of capital is just the tip of the iceberg. Let's just run through the other big risks here. 1. High leverage.
This cuts both ways. It magnifies your gains, but it also magnifies your losses. 2. Compounding drag. Because of that daily leverage, your long-term return can end up looking very different from just holding Nvidia stock. 3. Synthetic exposure. The fund uses derivatives, not the actual stock, which adds what's called counterparty risk. And finally, 4. Concentration risk. Everything, everything, is tied to one single stock. That means you are signing up for some extreme volatility.
So, after all that, after weighing this high-powered engine against some pretty serious internal risks, we get to the most important question of all. Who is this thing actually for? Let's run through a quick checklist to see if NVII could even possibly be the right fit for your portfolio.
Just take a look at this table. On one side, Nvidia might be a fit for a really active investor with a super high tolerance for risk, someone whose main goal is to blend that weekly income with direct exposure to Nvidia, and who really truly understands how options and leverage work. On the other side, it is absolutely not for a passive, risk-averse investor who's just looking for a simple, diversified, long-term investment. Not even close.
So if you're still listening, and you think you might fit into that very, very specific box, then your homework is just getting started. Step 1, you need to read the fund's prospectus. From cover to cover, and pay super close attention to the parts about leverage and return of capital. Step 2, compare it to other complex ETFs out there. Look at their structures, their fees. And step 3, you absolutely have to review the tax implications, because these distributions are treated way differently than your standard dividends.
Look, at the end of the day, NVII is a bold piece of financial engineering. It's designed for a very specific kind of investor, for a very specific moment in the market. It's trying to walk this incredibly thin line between high income and high growth. And that really leaves us with the final critical question that only you can answer for yourself. For your portfolio, is this bold new strategy the right risk for the reward you're chasing?